London, 1966. Hundreds of thousands of British drivers are paying premiums to a company advertising itself as cutting-edge and computerized, offering car insurance at rates other insurers can't match. Within days, that company collapses completely, and every single one of those policies turns out to be worth exactly nothing. Meet Emil Savundra. Savundra arrived in Britain in the 1950s with a resume already full of shady dealings across several countries, including a coffee-based swindle of the Costa Rican government. In 1963, he founded the Fire, Auto, and Marine Insurance Company, undercutting competitors by as much as half, right as car ownership across Britain was booming and drivers desperately wanted a cheaper option. The pitch worked spectacularly. By the summer of 1966, the company was pulling in roughly £4 million a year in premiums. The problem was what happened to that money afterward. Rather than holding it in reserve to actually pay out claims, Savundra and his co-director quietly diverted large portions of it for their own benefit, then falsified the company's balance sheet, claiming it held a substantial sum in securities that simply didn't exist. Investigative reporters at the Sunday Times eventually caught the discrepancy and started asking questions the company couldn't answer. Savundra's response was to step back from day-to-day involvement, sell off his shares to his fellow directors, and exit the company entirely. It collapsed within days of his departure, leaving an estimated 400,000 motorists holding insurance policies that no longer meant anything at all. What actually made Savundra infamous wasn't the fraud itself, it was what he did afterward. In 1967, he sat down for a television interview with a young broadcaster named David Frost, with some of his own defrauded customers seated in the studio audience. Rather than show any remorse, Savundra was openly dismissive of the people he'd ruined, treating the entire situation with visible contempt on live television. The public reaction was immediate and furious. Following a trial that ran 42 days, Savundra was convicted of conspiring to defraud his own policyholders. He was sentenced to 8 years in prison and fined £30,000. His former co-director received 5 years and a fine of his own. Savundra had built his entire business on being the modern, efficient option in a market ripe for disruption. In the end, the only thing genuinely efficient about the whole operation was how quickly it left hundreds of thousands of people with nothing.